Hello, welcome to day 3 of our 10-day Business Tuneup series. Yesterday, we focused on profitability, and specifically we looked at the concept of gross profit, where I would rather have you focus on what your actual gross profit is for your products and services rather than the total income or the final bottom line net income. The gross profit is your true indicator of what you're actually going to earn and what you have left over to cover the rest of your expenses and also to cover your own personal salary. This is where today we're going to start focusing on cash flow again. As I recall from before, cash is king for a business. And you need to have a steady, consistent cash flow in order for any business to thrive successfully going into the future. So today we're going to focus on cash flow boosters, how to get paid faster. And the one area that we're going to spend the most time on is talking about account receivables. This is the money when you sell something on credit to a customer. Account receivable is what the customer owes you. This is usually one of the key areas where you can try to get some immediate cash flow improvements. Because if you're a business that relies on customer credit and you have a lot of customers that for whatever reason they're not paying your bills, like for example in Canada, they just went through a postal strike for a couple of months. A lot of small businesses rely heavily on the postal service to get their checks coming in. All of a sudden, they had a lot of late payments, and vendors were using the excuse, "Oh yeah, I'll send you the check when they get back to working again." That affected the cash flow for a lot of my small business customers. So this is where you want to make sure you stay on top of your account receivables so that you don't run into these type of situations where you can't pay your bills simply because your customers haven't paid their bills to you. So you need to monitor this closely. So how do you do this? This is where, first of all, be prompt with your invoicing. As soon as you provide the sale or product or service, invoice them immediately. That's the first step. And actually on the invoice, you should actually get into the habit of saying what your payment policy is. Like they have 30 days to pay. Or you could even say you have payable upon receipt immediately or in 10 days. It's up to you to determine what your collections policy is. Something else to keep in mind is if you want to charge interest for those delinquent accounts, depending on your local jurisdiction, you often have to have a clause on your invoice, on the original invoice, that says what your interest policy is. Like saying, okay, on any overdue accounts, I charge 2% per month or whatever. You want to make sure that your invoices are worded properly so that you can legally collect and charge this interest. Another option you could look at is, can you give customers an early payment incentive? Like, for example, you might say, okay, this is normally due in 30 days, but if you pay in 10 days, I'll give you a 2% discount. That is an incentive to get customers to come to pay their bills faster. Think of it this way. When you have outstanding accounts receivable, you're basically acting as a bank. You're the working capital for your customer. They might not be paying you because they might say, oh, I'm better off keeping the money and I'll pay you at the latest day possible. And I'll avoid paying interest charges on my bills. I'll just pay my bills faster. This is where you don't want this to happen, especially if you're tight on cash. You need that money to be coming into your coffers, not sitting in your customers' coffers, working for them. Now, another follow-up is get a system in place where you send automated reminders saying, yes, you're overdue. Send out statements. A lot of small businesses don't do this. They just send out the original invoice and that's it. They never send out another piece of paper again. Just keep sending out those reminders. Maybe the client accidentally forgot that he didn't pay you yet. Getting a statement in the mail a month later might be a gentle reminder, and you might get paid very quickly. You might be embarrassed and say, "Oh, I forgot. I better pay this right now." If you ever end up taking people to court, like for non-payment, that's where having the paperwork may help you in court as well, showing what your debt is. Now, on the flip side, if you look at your accounts payables, it's the opposite. It's kind of like I just finished talking how it's important that you should be getting the money in from your clients to pay off as soon as possible. On the accounts payable side, you're kind of in the opposite role. You're the one that owes the money. And from there, it's almost the exact opposite advice. Can you delay paying your payables so that you get to work with the money in your pocket instead of giving it to your supplier? The longer you can pay your payables, the more that improves your working capital position. Now, there's a caveat though. I don't want you all going out saying, "Okay, I'm not going to pay my suppliers until 3 months from now." This is where you don't pay your suppliers, especially if they have their payment terms. Well, they could be in a position, they could be charging you excessive interest rates, which isn't good. That's going to cost you more money in the end. Or they may decide, "I'm not going to give this person credit anymore. They got to pay cash from now on." Then that really puts you in a bind. So you got to use this strategy with some reason. You don't want to get carried away. But if that client on their invoice says you have 30 days to pay, well, there's nothing wrong with you taking the full 30 days to pay. You're within the payment terms of that invoice, and that's perfectly legitimate. To take 2 months to pay, could get you into trouble. And you're going to see it varies from industry to industry. I do some contract work for the government. There they have a 30-day policy, and they stick to that policy. I don't see a penny until roughly the 29th or 30th day. If you ever do work in the oil patch, they often say, "Well, yeah, it's a 3-month cycle from start to finish," so they have a normal payable terms of 90 days. Or at least that's when they pay their bills, is 90 days. It varies from industry to industry. Just ask yourself what it is like in your industry. So that's the second way you could boost your cash flow, is looking at your accounts payables or managing it. The next item, that's a very big item for some businesses, is inventory. Inventories often can be a major headache for some businesses. You always have the conflicting situation where you would like to have just enough inventory to make ends meet, because that would minimize your cost of holding that inventory and freeing up your cash flow. But you have to balance that with what happens if there's shipping delays, if you get a sudden surge in demand for certain items and you don't have them in stock. Is the customer going to wait for you to reorder the stock, or are they going to go elsewhere? What happens if you have supplier issues? There's a lot of things that can go wrong. So it's a balancing act. You have to juggle, do I just have just-in-time inventory where I only bring in inventory when I need it, as I need it, or do I want to have a little bit of a buffer on hand? But this is where you need to manage your inventory. You don't want to get obsolete inventory, because that's going to cost you money in the long haul. And the lower that you can maintain your inventory levels on average, the less working capital you're going to need to keep your business going. And it's going to free up your cash flow. So in fact, you have different terms for it. I call it cash flow gap. Basically, if you take a look this kind of gives you an indication of what the cash flow status is like within your business. So you need to know three measures. What's the average number of days that your inventory sits in your inventory? So from the time you bring in the inventory, how long does it sit there on average before you sell it? Then, what is the average number of days it takes you to collect on an account receivable sale? So the day you sell the item, the customer incurs a charge. How many days does it take them on average to pay you? And then finally, the number of days to pay the accounts payable. How long does it take for you on average to pay your bills once you incur the charges? So essentially, if you take the number of days of inventory on hand, add the number of days it takes to collect the receivables, minus the number of days it takes to pay your bills, this kind of gives you an indicator. I call it the cash flow gap, the number of days in the cycle. Now, this is where the higher the number, that usually means you're basically footing the cash up front, and you got to wait longer for the cash to come in. So just to give you an example, day one, you bring in the inventory. You buy some inventory, and on average, it sits in your shelves for about 90 days before you sell it. Okay, well, that's fine. That's 90 days. Then you actually do sell it. Then you say, okay, well, my customers usually take me 20 days to pay me. So you add the 20 to the 90, that's 110. So from the day you bought the inventory to the day that you actually received the cash from the customer for that piece of inventory, 110 days has passed. Now, for the accounts payables, say you have to pay that bill within 30 days. Well, that's where, out of that 110 days, your money is not tied up for the entire 110 days. It's only tied up after you pay the bill on the 30th day. So your money is only tied up for 80 days. That's your cash flow gap. It's 80 days. But that means you have to have the working capital on hand, which usually means cash, in order to finance that 80 days when you've had to pay for that inventory, but you haven't got paid for it yet. Likewise, say you're in the service business, you don't have inventory you have to pay for, so your day's inventory in hand is 0. You might collect on the spot. So I know for my tax return, I expect payment the day you pick it up. So my days to collect receivables 0 because I have no receivables. And if I take 30 days to pay my bills, I actually have a gap of negative 30 days. This is where essentially it's helping. This is beneficial for my cash flow. I don't have any upfront costs, but I don't have to pay my bills for 30 days. Now, again, I got to be careful. I better make sure I do pay my bills in that 30-day period. But this is where, again, I'm using the accounts payables to my benefit to boost my cash flow. So that's just a rough overview of the cash flow gap. So this wraps up the content I have for today. So going to our action plan, I have several things I want you to do. First of all, I want you to make a list of your outstanding invoices. And if you have any significant outstanding invoices, send out reminders to your customers about that invoice. Take a look at what incentives you can provide for your customers. Like, can you provide a 2% discount for paying in 7 days? Ask yourself if this might be a feasible option for you. And then second, and this is where there might be the most work, calculate your cash flow gap for your business, just so you have a general idea of how it may impact your business. And again, as the previous 2 days, I've included the cash flow statement. If you go to day 3, that's where the first section is, where you can list all your outstanding invoices, the amount owing, and what action you took to collect on that account receivable. Just do that for all your major receivables. The next question is, what incentives can you provide? Just make notes of what you could look at doing in your business. You don't have to implement it, but just come up with ideas of what you may do. Then you may need to take a closer look at whether it actually will be worth your while to do this or not. Now, finally, the bottom section, this is where you calculate your gap. And you're going to need some numbers, which you may or may not have. If your accountant prepares a balance sheet for you and an income statement every year, you may have a lot of these numbers. If not, you may have to do some estimates. The first estimate, what is your total cost of goods? That's like, you could go back to yesterday's exercise and ask yourself, what are my direct costs for calculating gross profit? That's your cost of goods, the variable costs incurred to determine your cost of goods. So you may have this number already from yesterday's exercise. What is the average inventory you have on hand at one time? This, again, you can estimate this. Then ask yourself, what is your total accounts payables you have on hand right now? Finally, what's your total sales? What percentage of your sales is on credit? Because you do have cash sales. If only half of your sales are on credit, that's what we need to determine. How much outstanding receivables do you currently have? And this will come up with our average days of inventory, average days to pay your payables, and average days to collect on your receivables. And it will come up with a cash gap. So just for an example, I'm going to say last year our total cost of goods were $100,000. My inventory on hand was $20,000. So just based on this, if I have $20,000 of inventory and I sold a total of $100,000, that means roughly I have this inventory on hand for 1/5 of the year, which is roughly 73 days. Now, if I look at my payables, say I've got $30,000 of payables. Now, this $30,000, it's using this cost of goods. This is where you're going to have some differences. This calculation is focusing more on the direct cost of providing your product or service. It doesn't account for the overhead costs. So in this case, it's saying, yeah, it's taken me an average of 110 days to pay my bills. Now, if I'm in the oil industry, this might be normal. They take 3 months to pay on average. But in most businesses, anything over 30, that probably should be a concern that you have some bill payment issues. Then finally, what's my total sales? I'm going to assume it's $200,000. 75% of that is credit sales, and right now I've got $15,000 of account receivables. So right now it's taking me an average of about 36 days to collect. And for some reason it's actually almost working out to almost zero. I didn't expect this to be this perfect, but basically what's happening, you take my 73 days plus 36 and a half minus my account receivable of 109, it's working out to zero. Basically, I'm kind of breaking even in terms of cash flow. As I'm laying out the cash, I'm receiving the cash. Now, the only concern, though, is I may have suppliers that may not agree with my 109 days to pay them. Odds are I'm probably going to get my credit cut off with them. So this is just one way of how you could look at using this tool. So if you don't have precise numbers, just work with the best estimates you have, just as long as you have a starting point. Even that would probably put you ahead of the average business owner in terms of understanding this. So that wraps up my presentation. Tomorrow, we're going to be taking a look at pricing and profitability, taking a look at your pricing strategies. So until then, I will have a good day and I'll see you tomorrow. Thank you.